Good afternoon, everyone. Gabe Velazquez here with you on a Tuesday, 14 March. Welcome, everybody. Hope everybody's having a wonderful trading week. All right, let's get right into it. Lots of chop, lots of stuff going on. We talked about the banks. Yeah, obviously, that is an ongoing topic. So let's get into it. Couple things. I'm going to be doing a class literally here in about an hour, actually 2.5 hours at 4 o'clock on a very good strategy that's actually been working. I'm actually going to show you guys some data on that, some of the kind of a smaller sample size, because we just started doing these about a month and a half ago, but so far pretty good. So if you want to attend the class, there's still link. Go on Twitter, or I think there's a link below. You can actually still register for the class. It's going to be at 4 o'clock. It's 1:30 right now, so we still have time to do that. So that's coming up later this afternoon. Okay. All right. Let's get into what's going on. Obviously, the bank crises, or whatever you want to call it, the Silicon Bank. We talked about this on Friday. That caused a lot of interesting things, the massive rally in bonds, the big sell-off in stocks. Now things are calming down a little bit. The VIX jumped over 30, all the way back down. Interesting, all the way back down into the mid 20s today, actually low 20s. Okay, yeah, Jim. So where are we at? So here's the thing. Over the last 2 days, since the whole thing imploded on last Thursday, basically what's going on, if you look at the S&P, we hit that low on Sunday. We had rollover, but essentially we are now again stuck in a range. And it's very clearly defined. All you got to do, again, look at your charts, pull up your charts right now. You should do that. I know everybody wants me to show you the charts. Well, I have free classes. You can spend 5 days with me. You want to look at charts all day, we'll look at charts all day. We can set up a Zoom call privately if you want to look at charts. But anyways, look, 3970 to 3840-ish. Very, very clear defined range in the S&P. Okay. In fact, we've been back and forth all day today. We rallied up to that 3970 area, fell back down midway to the kind of chop at 3900. And so that's kind of where we're at. So after all the hysteria about the banks, after all of every bear came out, blah, blah, blah. Here we are again, just range trading again with no type of follow through. Looked like we were going to break down. If you look at the bigger chart of the S&P, just kind of focused on that right now. We basically are right back to the January. There's that big old range back in December. We're sitting right back, rallied almost 100 points off that, and essentially have gone nowhere and continue to just churn and burn here. A bit challenged for some of you that continue to, again, maybe try to sell the breaks, maybe got too bearish at the lows, and so on and so forth. So that's kind of where we're at. The big winner this week, even since Thursday, still has been the NASDAQ. So even the NASDAQ, in fact, the NASDAQ actually also nice range here, 11,800 to about, we're right at the top end, 12,400. It's huge range, but basically, and that's been pretty much the outperformer. And I think a lot of it has to do with the fact that interest rates plummeted. We had that massive rally in the bond market. I already mentioned that on Friday. We did actually pull back hard in the bond market today. And so all in all, big ranges in the averages. at the end of the day, that's really what it comes down to, and you got to be equipped to trade the ranges. You can't just, again, this whole notion that, when the market, on Friday after I got off with you guys, everybody was, again, very bearish and whatever, but those people are getting hurt if you are not equipped to deal with big ranges and you're trying to chase everything. So you're having the same problem that literally has been happening for last 6-7 months. Nothing changing, and it is what it is. What couple things that's going to happen now. So what's actually causing the ranges now and the more confusion, I addressed this a little bit on Friday, is the fact that now even today's CPI number is less relevant simply because now that the Fed's actually broken something. I've talked to you guys about it. I've read, I've written about it over the weekend, newsletter and so forth. Now that they've actually broken something, with this bank failure, now they're going to have to reassess any aggressive further rate cuts. And so that, and by the way, all of this is happening with the bank tightening, with the FDIC having to come in and rescue some of these depositors or whatever, monetary policy tightening up. That, in fact, is very disinflationary. In other words, ultimately, that's what needed to happen. And so on one hand, that's probably a positive going forward. On the other hand, is the next meeting on the 22nd going to be the last rate hike? I still think they're going to do 25 basis points, but I think that may be the last of that. And so we'll see. I think if that's the case, it's going to be really interesting. I think the market that's going to be super bullish for the stock market. So in any event, but again, doesn't matter what I think or anybody thinks. It's, what the market's the reactions of the market is actually much more important. So anyways, so in real simple, the averages, big ranges, all you got to do is just look at your charts, look at your big charts, S&P, NASDAQ, even the Russell, big range now in the Russell, 1736 up to 1836, 100-point range in the small caps, which by the way took the brunt of the selling because they are, I don't know if you guys realize this, but the Russell 2000, the biggest constituents in that, in other words, the largest percentage of stocks in the Russell 2K are regional banks, which obviously are the ones that got hit. Now, here's some opportunities for some of you as a direct consequence of what's been happening with the regional banks. There are, so I want to make two distinctions. There's the XLF and then there's the KRE. I don't know if you guys know the difference. The XLF is all the big money center banks. In fact, I think I mentioned on Friday, we're trying to get long JPM. That's a big money, the Citi, JPM, Wells Fargo, Bank of America. Those are what we call money center banks. That's the XLF ETF. Okay. The KRE, which is actually what we're focused on this morning with our members, and I think there's going to be some great opportunities below 40. Pull up KRE. KRE is the regional bank index, and you can see clearly that's gotten hit pretty bad. One of the things today that was notable was it rallied hard this morning. It traded all the way up to 49 and gave back half of its gains. Okay. So that could, it's going to be interesting to see what that does tomorrow, because maybe there is one more shoe to drop, so to speak, right? Maybe there's another bank failure in the workings. Wouldn't shock me in the least. But I think on the next washout, that KRE is going to be very, very interesting long-term situation there. So look at KRE if you're interested in the next, I think, again, that the next washout, meaning, we're probably going to have another bank failure. If that happens and they push that thing lower, below 40, there's some really good looking levels. Okay. That's kind of on a little side note. And every panic, every kind of crises does present opportunities. So there's a squarely, obviously, that's in the epicenter of what's going on with all the regional banks. So rather than sit here and blah 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 discuss all the intricacies of the banking system and all that jazz, I want to focus on opportunities that would present themselves. That's really, if you're a trader, that's really what you need to focus on. Okay. All right. Bonds. Again, this is the key. We had a huge bond rally. The 10-year. If you look at your chart of the 10-year, we came close back up to 116. We fell back pretty sharply today, which is really interesting. Very volatile. One of the things that's going to be a near-term negative for stocks is you got to have this, just like we had back in the fall, back last year in the summer. One of the things that caused the market to really sell off was the volatility of the bond market. We're getting that kind of volatility again with these huge moves. Even today, if you look at your bond charts, the 5-year, the 10-year, the 30-year, you can see even the TLT, man, that thing went from 109 yesterday, closed all the way down to like 104. So we're having some huge moves in the bond market. I don't think the market is going to really rally hard overall until we calm this bond market down. We got to get the rates stabilizing, bond market stabilizing. There are some levels in the 10-year above. The 116 obviously is the big resistance level from way back when. So that's something to look at. 116, you can clearly see we have two peaks up there. We had a level 115.45, 115.23. I'm sorry, 115.14, 115.23. That actually hit on the 5-year. Got a really nice pullback. Didn't quite hit on the. You can see that you can see that level on your charts if you're looking at like a 4 or 8 hour chart on the 10-year. And we've pulled back. Now there are, the next question is, are there any pullback levels? Yep. I'm looking at the 2-year, probably down around 101. That thing has had some massive swings as well. It went from 101 to 103, almost 104 in literally like 3 trading days. So, yeah, there are some levels below that look pretty interesting. And again, those will only hold if we, if this is the peak in interest rates and the Fed decides that, maybe it's time to cool it on the rising, raising interest rate front. So you got to be very careful with the bond market right now. You can clearly see, I don't need to tell you, if you're in front of your screen right now and watching your charts, you can see the huge volatility in the bond market. So, but again, there's some opportunities there. The levels are pretty big on the future side. Every level that you plot, even if it's on a smaller time frame, which you got to be careful with because a lot of levels get blown out on the smaller time frames right now with this kind of volatility. On the bigger time frames, let's say 30 minutes and higher, what you'll notice is a lot of those levels are $300, $400, $500 wide. So that's why I'm kind of deferring more to the TLT and doing options on that. So we'll have to see what happens. And I can tell you also, if we can't get this bond market to calm down a little bit, that's going to cause more bank dislocations as well. So watch that very carefully. Dollar really didn't do anything today. So there wasn't much to do with the dollar. It's consolidating, coiling up here. 104, let's call it 103.50. You can see that bunching up here, kind of clustering, ready for a break. What's going to cause it to break? Clearly, it's going to be another big. If we get another big drop in stocks, that probably gets the dollar to rally. But one of the things that's I had a lot of questions recently about why traditionally the dollar up until last week, anytime stocks sold off, the dollar had rallied, and in fact the opposite just happened in the last couple of last 4 or 5 days. Why is that? Well, because the bond market. So remember that the bond market is the count. Remember, it's an interest rate. Remember, currencies are driven by interest rates. And if you have plummeting interest rates, that's actually going to be negative for the dollar, because people buy the dollar as a carry. In other words, they buy the dollar because of the higher interest rate. They'll go to a like a yen, let's call it, borrow money there at very, very low interest rate, take that money and invest it in dollars. Well, if rates are plummeting, then people have to actually sell dollars to buy treasuries, and so that is the changing kind of dynamic. If you're puzzled why the dollar actually fell as stocks were falling as well, that could change again, as things normalize. But that is what it is. Okay. Now, all the currencies are pretty much doing the same thing. Of all the currencies, looking at the yen, I think I mentioned this. Yen's got some pretty nice levels. There's a big gap on the yen, rollover gap down around 73, 70, actually around 74. The peso has been pretty active. That's the, I keep talking about that currency. That's also been, actually traded down to that daily accumulation around 51.5. You can see that on the charts. We had a nice pop on that. Again, there's a big rollover gap coming up at 54 on the peso. We actually topped at the 55.75 weekly distribution that I mentioned. I think I mentioned it here. So that is a currency I would be clearly focused on. It's got some really nice movement. It's $5 tick. If you haven't traded peso, that's one. That's probably the only currency other than the yen that I would be actually involved with. The Swissy starting to look interesting. I did talk about that with my members this morning. That's looks like it wants to break out. The Swiss franc, that had a tremendous rally as well as a safe haven currency. So these safe haven trades are starting to come in. And you can see that huge rally took us up to 1.1141, which is again a very clearly defined distribution level, and it's pulling back. So that I would add the Swissy into the mix right now. So you got yen, Swissy, Mexican peso. Those are the three currencies I would largely focus on. Okay. All right. Moving on to the energies. Okay. Well, before I do that, gold. I know everybody's starting to get bullish on gold. We are actually long calls on NEM, the gold miner, right? Newmont. So that's in full disclosure there. Looks like after that massive rally with the dollar plummeting, as I just mentioned, still a dollar play, kind of consolidating now between 1900 and 1920. Clearly see that on the charts. Next move up would take us above 19. There's a little distribution area coming up here, but anything above that, I think ultimately if the dollar, if rates peak here, the dollar plummets down back to 102, 100. Gold is probably going to move back up to 19, all the way up to maybe 1900. That's actually our target on that thing. So, but it's also going to be, it's going to be predicated on what the dollar does. It's still gold, silver, all the metals are still predicated on the dollar. So silver also had a really nice pop. It's got some really nice shorting levels above 2250. So it looks like that's headed up there as well. Again, all setting up for the dollar moving lower. This is all kind of lining up together. So anyways, that's that. Notable today, oil broke down out of the range, right? So that's something you guys maybe were watching. So we had been holding 72.50. You can see that again in your charts very clearly. We had 1, 2, 3 Even yesterday, we bounced off of 72.50. We did break that really hard today. Oil is down even sharp, even in the after hours right now. Looks like it's headed down to 69.50 is the first level. I mean, we got that pivot from December. I mean, it could hold at that pivot right around the 70 mark, 70 and a half. You can see that on your charts as well. But again, could the pivots hold? Of course. But the first level I'm seeing is around 69.60. Also, if you're looking at USO, on that, if you're looking for maybe an ETF, USO or UCO, those are the two I'm looking at. You can see on the charts, if you're pulling up USO, which is the look around in the low 60s is a really nice looking level. We're sitting at 63. That's the close, right on the lows. So looks like in the low 60, right around $60, and then below that around 59. Those would be really, really interesting levels to get long the USO. Okay. Relative to if you want to not take the risk of the futures or maybe the volatility of the futures and all that. So that's that, and that was notable today because we did finally break down, and a lot of it has to do with also the notion that now that have some bank failures, the tightening of the basically with all the layoffs being announced, that the recession is probably closer rather than later, probably coming sooner rather than later. And that's putting pressure on because the perceived demand from oil and so forth. Okay. So that's interesting. Nat gas kind of meandering now. We still are in boil. It's had a nice move yesterday off of 240, filled that gap that I mentioned to you the other day. Had a really nice rally all the way up to close to 270, pulled back, and now it's kind of just meandering. All in all, there's a big gap to fill at $3. I think eventually we 270 is the next resistance in nat gas. If we can break above that, I think we're going to probably go up and try to fill that gap around $3. Everybody can see that. That was a gap from 2 Sundays ago in nat gas. We could just be settling in a big old range here until something changes on the weather front. So that's really kind of what it is on that. Lastly, we are trying to buy corn. The grain markets are moving. Wheat, I think I talked about, didn't quite get down to that 658 level I mentioned to you the other day. And then the soybeans also lifting a little bit. So I think a weak dollar probably helping the grain markets a little bit. And there's some really good shorting levels in corn if we can get this thing moving. It's just kind of sitting now in a little bit of a range, 610 to 621. Okay. All right, everybody. Let's see. There's a few of you in here. Any questions? Jim, I'll see you a little bit later. For the rest of you, again, if you want to join me in about 2 hours, I'm going to be talking about not something I've been testing this process out, this strategy. It essentially is kind of taking the what you guys all know as supply and demand and just adding one extra layer, anticipating where the big move is going to come from rather than waiting for the pullback, if that makes any sense. So I'll have some data to show you actual trades that we've done with that. It's not a big sample size because we just started implementing it, but it's so far it's actually working pretty good. But there is some specific rules. You can't just take any breakout trades because most breakout trades actually do fail. Yep. So anyways, all right, everybody. I'll see some of you guys later. If not, I'll see you on Friday. Have a great rest of your week. And we'll talk soon, okay? Take care. Have a good day.